What if I told you that 90% of day traders lose their money and that your chance of outperforming the share market is virtually zero? A new report by ASIC found that between the 16th to the 22nd of March, Australians lost $428 million on CFD products. Retail investors could not predict short-term market movements. If all retail investors held their positions for only one day, their total losses would have amounted to over $230 million.
So I've been buying and selling stocks for almost 7 years now. And although I've made an overall profit investing in the stock market, I've also made some really big mistakes that have cost me my life savings. I don't want you to make these same mistakes. So in today's video, I'm going to share with you guys the 6 biggest mistakes that I've made investing. It's important to understand that anyone can make these mistakes. So avoiding them can help you save a lot of money on your investing journey. These mistakes are really important to know about because we really are in unprecedented times. In March this year, we saw one of the most dramatic falls in the stock market before it rebounded by over 40% to levels seen in February. No one can predict where the stock market will be, so it's important for you to have appropriate risk management strategies because we ultimately don't know whether a vaccine is going to be developed and the stock market reaching all-time highs, or this dragging on for years and negatively impacting companies' earnings and share prices. So let's get into today's video. The first major investing mistake that I made was at the start of my investment journey, when I bought shares in a small cap business. I stumbled upon an online article talking about an Australian mining company called Sirius Resources, whose share price went from 5 cents to $5 after making 2 major nickel deposit discoveries. That's a 10,000% return on investment. This online article had claimed that it had found another small cap mining business called Segway Resources that actually had the potential to deliver a similar return on investment. Segway Resources had actually released a series of announcements to the market claiming they may have found a major nickel deposit and that they were going to fund a major drilling program to confirm whether this was indeed the case. At the time, I thought that this was a guaranteed get-rich-quick stock. I didn't want to invest in blue chip companies that only returned 5 to 10% a year. Unfortunately, this was a huge mistake because after buying $1,000 worth of shares, the company announced that it hadn't actually discovered a major nickel deposit after funding the drilling program. This sent the share price plummeting. And because the company wasn't actually making any revenue, it had effectively run out of money to sustain its business, ultimately sending it into administration and being removed from the stock market. So this brings me back to my first investing mistake, buying shares in small cap businesses or highly speculative stocks. Despite what you might think about picking the right stocks, investing in small cap businesses is extremely risky. The chance of you picking one that's going to deliver outstanding returns is basically the same as winning the lottery. Many of these companies are not at a stage where they are financially sustainable and often have to rely on capital raisings or private loans in order to fund their business. So if you are going to buy small cap stocks, only put on an amount that you are prepared to lose. Now, I'm not saying that all small cap stocks are bad, but it does take a lot of effort and research to find genuine small cap stocks that do have serious growth potential. Now, this brings me to my second investing mistake, which is buying more of a stock that's declining in value. And this is when I bought shares in the company called Slater and Gordon. For a while, this company was actually doing really well. My initial investment of $5.20 a share went up to $8 a share. And at the time, it was predicted to go even higher because it was expanding its business operations overseas. But it subsequently emerged that it was reporting work in progress as revenue. Work in progress was basically when it had billed a client, but the client hadn't actually paid yet. And when these accounting errors were subsequently rectified, it actually emerged that their revenue was substantially lower. It also emerged that the law firm that it had purchased in the UK was being investigated for fraud. These announcements sent the share price plummeting. At the time, I thought it was actually a good opportunity to buy more shares. So I ended up selling shares in a separate company that I owned in order to fund this. Not only did this mean that I had a huge part of my overall portfolio allocated to a single stock, but I was also ignoring the clear warning signs of this company that were being reported in the media. Of course, it then emerged that the company's balance sheet was in serious condition, sending the share price to basically $0. The share price hasn't actually recovered since, and I've lost over $6,000 on this investment. I'm not saying that buying more of a declining stock is necessarily a bad idea. Buying stocks when their share price is cheap is actually the investment strategy used by Warren Buffett. However, many companies do use creative accounting techniques to make their balance sheets appear a lot better than they actually are. And as an investor, it's extremely difficult to work out which companies are doing this. So this is why diversification is extremely important when investing in the stock market. Number 3, putting all my money in a single stock. It sounds like common sense, but a lot of people do make this investing mistake. I certainly did when I put my entire life savings on a company called Nearmap. And although I sold my position for a capital gain, the amount of money that I made on that trade did not justify the risk. My initial investment of $85,000 made me a total profit of $18,000. That's a 20% return on investment, which isn't bad, but it certainly doesn't justify the risk of potentially losing all of my life savings on a single investment. And if I was still holding those shares, I'd actually be down around 35%, or almost $30,000. And this would have been devastating to my life savings and my investment journey. So it is really important to not get emotionally connected to any stocks, and certainly don't put your life savings on one. Even if it is a well-established company, there are factors beyond the individual company that impact its share price. This includes the financial performance of other companies in the same sector, or interest rates, or even a tweet from Donald Trump. And this brings me to my next mistake, which was holding shares for less than 12 months. Going back to my previous example, I had sold my Nearmap shares within 12 months of buying them because I could not deal with the psychological stress of having all of my life savings on a single stock. I also couldn't predict where the share price was going to be in 12 months, and so decided to close my position as soon as it was profitable. This meant that my total profit made on that trade was taxable for the financial year. As a result, I was taxed $7,000 in total profits that I made for that year. That was $18,000 profit on Nearmap and the $6,000 loss on Slater and Gordon, meaning that after taxes, my take-home pay was only about $5,000. Essentially, I had risked $85,000 to make only $5,000. Which is actually a really poor trade. And this is why I advocate for only buying shares in companies that you intend to hold for at least 12 months. Holding shares for a minimum of 12 months means that you're only taxed on half of the capital gain that you make on that trade. Because at the end of the day, it's about how much money you take home, not about how much profit you make on trading. So you should only buy shares in companies that you intend to hold for at least a year. Otherwise, you're just risking losses and limiting any potential gains. The next investing mistake that I've made is trying to time the market. This is basically where I was sitting on the sidelines and watching the stock market go up and down, whilst never pulling the trigger and actually investing. I did this because I was so averse to any potential losses, and I thought that I could put all of my cash into the market when it had hit the bottom. But trying to time the market is almost impossible. You'll either buy before it hits the bottom, seeing the value of your investments go down further, or you will just miss the market bottom and wait for it to go back down whilst it continues to go up. This happened in March this year when I was too hesitant to buy when the stock market was in free fall, and continued to sit on the sidelines and see it rally by almost 40%. The problem with this approach is that it gets worse over time. The longer you wait to invest in the stock market, the more difficult it will be to become, because over time you'll have more cash available to invest, making you more risk averse and less likely to invest. It will also mean that you spend more time looking back in hindsight and wishing that you invested here, or here, causing you to just wait even longer for the next market bottom. The lesson here is that consistently investing over time is what's going to lead to profit. Even if you had bought right before the GFC crash, you would have still made a 10% average yearly return. And I know that is a lot lower than if you had got lucky and invested all of your money in March 2009, when the market hit rock bottom. That would have made you an average yearly return of over 30% a year. But ask yourself, would you have really put all of your life savings into the stock market in March 2009? Most people would have been too scared to. Plus, anyone who just consistently invested during that time would have still bought during March 2009 when the market hit rock bottom, making the difference in investing returns even less. And this brings me to my final investing mistake, which is trying to pick and invest in individual stocks, as opposed to just buying a passive index fund that tracks the overall market. I know it's very tempting to think that you can outperform the market by picking individual stocks, but the chance of you doing so is actually very slim. The desire to pick individual stocks as opposed to a passive index fund that just tracks the overall market actually comes back to a core psychological concept called the locus of control. And this is where we feel more comfortable picking individual stocks because it's our own choice, as opposed to not having the ability to pick our individual stock allocation through a passive investment. As a result, we believe that actively picking individual stocks is going to lead to a better performance as opposed to just buying a passive index fund, because we are in control of the portfolio. In actual fact, the opposite is true. Passive fund investing is likely going to give you a 7 to 10% average yearly rate of return, something that is very difficult to beat over the long run. Again, I'm not saying that it's impossible to do well with individual stocks, but most people do not have the time, knowledge, or the expertise to research and evaluate whether an individual stock is a good buy. So I hope this video helps you guys on your investing journey. Obviously, like anything in life, we all make mistakes, but the most important thing is to learn from them. No one is a saint when it comes to investing. So if you have any other questions, just leave them as a comment below.